Are you sure you want to ignore the signal that's flashing in China right now? Not on Twitter, not on YouTube, but inside the warehouse numbers. Because while most Americans have been watching the US price chart and arguing about RSI, something quieter has been happening on the other side of the world. Shanghai's exchange-tracked silver stockpiles have been sliding toward levels traders are calling the lowest in about a decade. And when China, the world's manufacturing engine, starts running its visible buffers down, that's not sentiment. That's plumbing. Let's ground this in what can actually be verified. Multiple market reports in late 2025 described inventories in warehouses linked to the Shanghai Futures Exchange, SFE, falling to their lowest levels since around 2015. Bloomberg coverage highlighted that exchange-tracked inventories in Shanghai had sunk to the lowest in roughly 10 years. ING wrote about the same phenomenon. Chinese silver stockpiles linked to the SFE hitting their lowest in nearly a decade. That's the headline fact, not a rumor, not an anonymous screenshot, a documented shift in the most important physical adjacent dataset China publishes. Now here's the twist most people missed. This drawdown did not happen in a vacuum. It followed a record export burst. In October 2025, Chinese silver exports surged to more than 660 tons, widely reported as the highest monthly volume on record. That metal didn't move because everyone suddenly felt generous. It moved because the global market was strained. London, still the world's primary OTC hub, had been dealing with tight liquidity conditions in silver, and large flows from the US and China helped ease that squeeze, according to Reuters reporting in October. Read that again, slowly. Metal had to be mobilized internationally, at scale, because price signals were screaming that the usual inventory cushion wasn't where the market needed it. And yet, after that relief valve opened, the tightness in China didn't magically disappear. Reports continue to point to low local stockpiles and signs of near-term stress in Asian pricing structures. That's the part that matters for what happens next, because it tells you the export wave didn't solve a surplus problem. It was triage. So what does this mean for an American audience watching silver trade in the 60s? It means you're not just looking at a chart. You're looking at a global inventory network where metal gets pulled from one region to plug a leak in another. When those plugs start coming from places that are also running low, you stop having a buffered market. You start having a market that has to ration demand through price. And the timing is not hypothetical. We saw extreme price action around December 10 and December 11, 2025. Trading Economics lists silver reaching $64.32 in December 2025 as an all-time high in their series. Around that same window, U.S. futures data showed big daily moves. Silver ran up hard into the low to mid-60s and then snapped back sharply. For Americans, that's the moment the story stopped being silver is slowly grinding higher and became, why is this thing moving like a high beta tech stock? Because the underlying support isn't just investor excitement. It's the physical balance sheet. According to the Silver Institute's World Silver Survey 2025, produced with Metals Focus, the market was forecast to post another significant deficit in 2025, about 117.6 million ounces, commonly rounded to roughly 118 million. That would mark the fifth consecutive year of deficits in their framework. Deficits are easy to say and hard to feel, until inventories start doing the talking. A deficit by itself doesn't force a crisis if above-ground stocks are abundant and willing to come out at the right price. But when multiple regions simultaneously show tightness, Shanghai stocks sliding, London borrowing costs spiking earlier in the year, metal being flown or redirected across the map, that's when deficit stops being a line in a PDF and becomes a real-time constraint. Now, layer in the investment channel. One of the most underappreciated features of 2025 is that silver didn't just get bought by stackers and coin shops, it got pulled by institutional structures, ETFs and exchange products that require physical sourcing and custody. Reuters, reporting about India in October, made the mechanism plain. Physically backed ETFs must acquire silver, and when physical premiums blow out, those products can even suspend new subscriptions to protect investors from distorted pricing. That's not theory. That happened. And India matters because it's not a nice-to-have buyer. It's a structural buyer. Reuters reported that in the first 8 months of 2025, India's silver imports fell 42% to 3,302 tons, even while investment demand surged. That's an unusual combination. Less incoming metal, more demand pressure. It's one reason Indian premiums widened sharply versus global benchmarks during the year. When the world's biggest consumer is paying up locally and still can't easily secure supply, it changes the global flow picture. It turns the market into a competition for available, deliverable metal, not just a paper bidding war. Now, connect the dots with China again. China is a manufacturing heavyweight. It's also deeply tied to solar deployment, electronics, and industrial fabrication. Late 2025 commentary repeatedly pointed to photovoltaic demand as a key industrial driver globally, and Chinese seasonality often makes the fourth quarter a peak installation window. When Shanghai visible inventories are low into that kind of seasonal demand, it creates a specific kind of risk. Short-term tightness that can show up as backwardation, premium expansion, and aggressive restocking behavior by fabricators who cannot miss production schedules. And here's where the $70 rocket fuel framing comes from, without telling anyone to invest in anything. In a market that's already printing record highs near $64 in December 2025, you don't need a new story. You need a trigger. Tight stockpiles in Shanghai are one of those triggers because they're not emotional, they're logistical. They hint that the system is using up readily mobilizable metal faster than it can comfortably replace it. That's why the missed signal matters. The loudest narratives are usually US-centric: Fed cuts, dollar weakness, speculative flows. But silver is a global physical commodity with a financial wrapper. When a Chinese exchange warehouse number hits decade lows, the wrapper can stretch a lot faster than most people expect. Now, a reality check, because facts only also means admitting what we do not have pinned down. You may see claims like SFE stocks are down 40% from the 2024 peak, or specific moving average levels, or specific volume spikes cited to the decimal. Those might be true depending on the data set and timestamp, but unless the exact source, date, and calculation method are provided, they should be treated as unverified assertions, not established facts. What is verified is the broader direction and the decade-low characterization reported by major outlets. Same with 660 tons exported to London. The verified fact is Chinese exports surged to more than 660 tons in October and helped ease London tightness, as described in major reporting. The to London share is part of the narrative of flows and relief. The clean way to say it factually is that exports surged and London liquidity conditions eased as metal arrived from the US and China. So what are the key factual signals an American observer can track from here without turning it into a trading pitch? 1. Shanghai exchange-linked inventories and whether they rebuild meaningfully or remain pinned near decade lows. If they stay low, it suggests domestic tightness persists even after record exports. 2. Signs of regional price stress, backwardation patterns, lease borrowing costs in major hubs, and premium spreads that indicate immediate demand outbidding future availability. 3. Global deficit estimates from reputable annual surveys, because they define whether the market is structurally leaning on above-ground stocks. 4. India's import and premium situation. Because India's demand can absorb surplus fast, and when imports drop while demand rises, pressure appears elsewhere. And 5. What happened on December 10th and 11th, 2025 matters as a behavioral marker. That's when silver demonstrated it can move violently at elevated prices. Whether the next leg is up or down, That volatility is itself information. It tells you the market is no longer sleepy, and the marginal ounce is getting more expensive to locate. This isn't a promise of a straight line. It's not a guarantee of $70. It's simply the anatomy of a market where visible buffers in Shanghai have been drawn down, record exports have already been used as relief, and the global balance remains in deficit by roughly 118 million ounces in 2025, according to the Silver Institute survey. When those conditions stack, price doesn't need a conspiracy to move. It needs a shortage of patience and a shortage of metal in the places that matter. If you want more breakdowns like this, focused on verifiable signals, not hype, subscribe and leave a comment telling me which data point you think matters most. Shanghai inventories, China export flows, India premiums, or the global deficit.